Hello there. Good morning, everyone. Joining us from the Singapore, Hong Kong part of the world. I know we had some signups from Australia. Good afternoon to you. I put it up trying to convince some people on the West Coast US that it wasn't too late to do this webinar. So if anyone of those have chosen to make it today, good evening. We'd like to thank everyone and welcome you to the next in the Sherpa Process Alpha webinar series. I believe this is webinar number 6. And today we're going to be moving to kind of a different part of the process. We're going to be moving to a topic that we call understanding the portfolio construction problem. And when we think about this, what we're going to talk about specifically today is really honestly where the whole process kind of starts, which is to say, as a PM who's working on portfolio construction, what are you good at? What is the quality of your ideas? What is the quality of your alpha that you're trying to express in your portfolio? And really, how should that influence your portfolio construction decisions? So we'll do as, for those people who are new to the Sherpa webinars, we're trying to be about 30 minutes. Might be a little shorter, might be a little longer. We're happy to take questions midstream. So if something comes up and you just urgently have to get it off your chest, by all means, feel free to put it in the chat and we'll try to tackle it then. Otherwise, we'll certainly do any questions that we haven't answered at the end of the session, and we will be happy to stay on. I think the last webinar we were on for half an hour almost after the presentation going through Q&A. So if you have any questions, we're happy to go through them as long as you'd like. So today, the agenda, we're going to crash course through a quick sort of introduction about how we can think in simplified terms about idea quality. We'll think about some additional important considerations, and the specific elements we'll talk about today are going to be score quality and persistence of ideas. Then we'll move into really taking this to a practical application and analyze a set of ideas historically. Then we're going to look at how we can take the ideas and take the information we get from that analysis to build the best portfolio to express that, and then how we can bring systematic portfolio construction techniques into the process to maximize the value in those ideas. And of course, at the end, we'll get questions. So as I said, practically speaking, we're moving from a different part of the process of portfolio construction than we typically have talked about in our webinars to the beginning of the process. So when we look at the process of portfolio construction at Sherpa, we're thinking about 5 distinct stages here. So the first stage is to understand the alpha inputs. So understand how we can try to capture that alpha in the best way so we know what is the baseline on which we're trying to build the portfolio. What is the basic ingredient we need to use? Subsequent to that, we can then understand how does the portfolio need to be set up, objectives and constraints. We can talk about how we can calculate that portfolio subject to those constraints to capture that alpha. We can then explain why that portfolio should be good going forward, and then establish and manage workflows to refine that process, to operationalize it, and to make sure that people are generating consistent alpha from that process. So previously, we focused mostly on parts 3 and 4. So how do we actually calculate the portfolio, and how do we explain why that portfolio is good? But today we're going to start really diving into number 1. How do we understand what the alpha is and how it's going to influence that decision? And so this really is the first step. And I think most PMs have some set of techniques they already use to do this.
But fundamentally, if you don't know what you're good at, if you don't know what you expect from your alpha, it's going to be very difficult to design your portfolio in the best way to capture. If you're very good at, picking long side ideas and you're a long short PM, then you maybe need to think about how you do your short book a little bit differently than if you're somebody who's really an expert at shorts and longs isn't really your thing. And so thinking about and understanding in some detail what the strengths are in your ideas really is going to drive the rest of the portfolio construction process. So as we start to think about this, we're going to try to keep it pretty simple. At the end of the day, I think one of the things that a lot of quantitative and systematic shops get distracted on is getting too far to the weeds of the math and not enough at making it understandable and useful to a PM who's trying to digest that math. And so we're going to use metrics to answer really some basic questions. How many ideas do you have at a given time? How well have those ideas performed? And how risky are those ideas? So we're going to use some common metrics for this. So how many ideas do you have? On average, how many active ideas do you have in your portfolio, on your watch list, by group, by score, by sector, by industry, but just simply on average, how many active ideas do you have? How well have they performed? So this is going to be, again, we'll keep it quite simple. So when we think about idea quality, we always want to compare that against the relevant benchmark. Absolute return, if you're an absolute return strategy, and you really don't have a benchmark, then maybe you want to look at absolute returns. But for the most part, if you have U.S. equity ideas, you want to compare them against the S&P. Are your ideas better than what you would expect just picking blindly? So we'll look at how well the ideas have performed in returns, as well as risk-adjusted returns. And then in terms of risk, everyone talks about volatility. At Sherpa, we always are focused first and foremost on drawdown, because drawdown is what really hurts. And so we're going to think about idea quality in those 5 really basic terms. And so we always talk about, and this ties in a little bit to the second part of the process, objectives and constraints, the 3 basic levels at which you think about your ideas and at which you think about portfolio construction. So one is the individual assets. And obviously, when we think about it, analyzing individual assets, that's highly idiosyncratic. And there's only so much you can do with individual assets in terms of a risk profile. Now, when we start to group our assets and group them by, say, conviction score, an alpha score, quality score, or group them by sector, by industry, by country, then we start to really drill down a little bit into how good we are at scoring or at grouping our assets. And then finally, we can think about the assets at a portfolio level. And so a lot of what we talked about before is this third level, is the portfolio level. And a lot of what we're going to talk about today is thinking about the assets at level number 2, which is to say the group or the scoring level. So when we talk about score quality and thinking about the grouping, again, we want to keep this simple. We want to keep this easy to understand so that the PMs can understand and take value out of this analysis. So very simply, we want to say, are your scores good? So if you are saying an asset is likely to be better than another asset in your portfolio, statistically, does that happen? Do your higher scored assets outperform? And then second, do you have the right degree of granularity? Because in our experience, most shops overthink this. They get too complicated with granularity. They have too much variation. You'll see this all the time if you were to actually go through specific, explicit expected return projections. Practically speaking, there's too much information there, and it's either diminishing returns, if not outright destructive. So typically at Sherpa, we try to keep things simple, 1 through 3, 1 through 5. If a PM's really good at that, maybe we can add more granularity if they want to. But in our experience, keep this simple. Couple groups, are they good? Make it easy. And so then the second side of this is going to be persistence. And so persistence is to say, how long are your ideas good? So obviously, the standard way that most people think about their ideas is that they're looking for a particular market price action that's going to cause them to close out a position. So this could be a stop, it could be a price target, it could be a fundamental development, you name it. But if we're thinking about really the best way to capture your ideas and you're analyzing a historical track record, sometimes that might be leaving money on the table. Every PM has times when they've, sold out of a position only to watch it continue roaring. And so if we look at it statistically, we want to think about how good are our scores and how long are those scores good, because thinking about how good the scores are and how long those scores are good is going to have a direct impact on the portfolio construction problem we set up to capture the alpha in the ideas. And so to do that, what we're going to look at today is we're going to look at a couple of different approaches that try to test the sensitivity and try to understand these inputs. So for score quality, we're going to use the idea stream to create score-weighted portfolios, as well as more equally weighted portfolios that disregard scores. And then for persistence, essentially what we're doing is we're going to look at the actual PM source to say, how long did they have it in their set of scores and their set of ideas? And then we'll experiment with using some fixed holding periods. And so we're only going to show 2 today. Richard's run the numbers on quite a few more, but it would be overkill and no one wants to see that. So we're going to talk really just about those 3 different persistence approaches. So before I hand it off to Richard to start really diving into the data, the PM we're looking at today
And so this is relevant for any type of PM, but just so that everyone knows and sort of understands apples to apples, we're looking at large cap US equity. So when we talk about benchmark relative performance, as all of the returns are going to be, we're looking at the S&P. It's long only, so this PM actually has some just differentiation on the short side, but that's not something that we're going to have to look at today. It's only long ideas. They're scored 1 through 5. Fives in this PM's mind are the best. Ones are the worst. The idea history is going to be analyzed from 2018 to 2020, and ideas in their raw form can enter and exit at any time. So with the table set, Richard, let's dive in. Let's look at some of these ideas.
Yes, thanks, Stephen, and welcome everybody to the second bit of this, where we'll look a little bit more at the data. So here we've just taken, and sort of jumping straight into the numbers, here we've taken the cumulative returns, benchmark relative. So again, everything, as Stephen said, everything in this presentation is benchmark relative. So it's excess return over the benchmark. Cumulative returns of this PM's ideas grouped by the score that the PM assigned to each of the ideas. And you can see the score from 1 to 5. Clearly, they have the majority of their ideas are scored 3, 4, and 5, but there are some small number. You can see the average number of 1s and 2s is 4 and 7. And you can see that, of course, the general trend is bottom left to top right, which is always a good thing in cumulative returns. There's some variability in the quality of the scores. Interestingly, you have the 1s which have the highest overall return, but clearly driven by the large spike up right at the end of its period, and with a very small number of actual shares that are scored on that, so therefore subject to a lot of idiosyncratic risk, which we will see more over time. So this is basically the raw scores coming from the PM analyst system process that they use themselves, and what can it generate when turned into portfolios in quite a naive manner, but just saying, okay, we did a portfolio of 1s or 2s or 3s or 4s or 5s. We take that portfolio or that set of scores and this is the first part of the question, was like, how much value is there in those scoring metrics, right? They have selected out of all the possible, I think that the universe is 700 or 800 liquid stocks. They have selected some number of stocks at any point in time. And at any point, it looks like an average of like 120 or so stocks. And if you just said, what would be the return stream of those selections weighted by the score? You get this, and it's reasonable. A Sherpa of 1.2, that's pretty good, and a drawdown benchmark relative drawdown of 3 or 3.5. That's pretty good. Interestingly, if you throw away the score and just take the selections, and the difference here looks very subtle, but we'll get into this in a bit more detail. If you throw away those scores, the 1, 2, 3, 4, 5, and just take the assets they picked, you actually do a little bit better. Your Sharp goes up, your drawdown goes down, your vol goes down, your return goes up. Marginal in this case, but let's see how this evolves. This is the first point of question. The selection is clearly good. Is there any value in the score, in the conviction? If we look, rather than taking their defined the holding periods that they have, and they held them for variable amounts of time based on whatever it was that caused them to exit the positions, we said, okay, let's hold it for a shorter period of time. And here we've taken a short holding periods. Again, it doesn't matter what it is, but a shorter holding period. Of course, the first result of having shorter holding periods is at any point in time you have less assets in play. So any single asset moving has a bigger impact on your portfolio itself. And you can see that you've got the 1s and the 2s. Suddenly you get massive returns, but of course huge volatility and really not practically executable, because you'd have to have 25% of your portfolio in any one stock or whatever, and you're probably going to break a lot of your mandate issues. But you can see, so shortening the holding period has the primary impact of reducing the number of assets and therefore introducing much more single stock idiosyncratic return characteristics. One of the interesting things on the shorter holding period, though, if you then say, okay, let's just take the full portfolio rather than break down by scores and look at the return difference between the scored versus non-scored, suddenly you're seeing that the non-scored is significantly outperforming the scored. Right? The non-scored is significantly outperforming scored. So again, further evidence that the process that initiates all this, which is the PMs and analysts choosing stocks, is very, very good and selecting great assets. But there's a bit in that process where people are being asked to differentiate between the stocks they've scored, and that part of the process seems to be actually reducing overall information and therefore reducing alpha. If we lengthen the holding period, we get a slightly different looking picture, slightly more stability as we'd expect, because we have more assets in play at any point in time. The fours seem to do very nicely in this. But what, again, comes out is when you look at the difference between the scored and the non-scored again outperforms the scored. So we've got a much more stable return stream with a longer holding period because we've got more assets. And this is, equity, it's long hedged. So you're getting the benefits of risk diversification while still selecting or picking your assets. But again, your scores are not actually helping. Your asset selections are great. Your scoring is not helping. Now, what's going on, right? So why is that? Well, you can see that as you go down this table, the top row is their own raw holding period. The second row is the short holding period, and the third row is the third section is the long holding period. You can see that as you increase the holding period, the fours start really performing very well. But the volatility and the sharps of the fours is the thing that drives the excess return. It's saying, oh, this is where we want to be. We want to have these longer holding periods, we want to have more stability, and we get the benefit from the assets we've selected better. And it happens to be in the fours, but there's no guarantee that's always going to be the case.
But if you look at the fives there, for instance, if you just took the raw, and this is why you have to, I think, look at this, right? If you simply take the raw, the fives are better than the fours, they're better than the threes, and there really aren't enough ones and twos. So you would think just with the raw out of the box, you'd think the fives are quite good. But yeah, practically, maybe not.
Practically, maybe not. The fives might be good in that very short holding period or their own holding period, but actually when you try and build a stable portfolio, which is what you have to do to meet your mandate, they're no longer so useful. And this reflects again how many assets are there in any given period. The short period, the middle row on this, the numbers for the ones and twos, really impossible to use in any sort of on its own portfolio. As you go through, as you go up in score, what you do see though is that the level of risk is reducing. So there is something going on here where you can see that the assets which are selected as ones and twos clearly have a higher drawdown across the board, and a higher vol than the threes and fours and fives. So there's something going on here. And the question is, well, how can we benefit from this? How can we actually create a portfolio which takes advantage of the alphas in here without being destroyed by this extra volatility and drawdown, and do what you want to do? And we'll see that's actually the final stage of this process where the whole Sherpa ORS system comes into play. I just want to revisit this issue of scores though before we look at that. This picture here shows all three different holding period types, the raw holding period, the short one, and the long one, and compares the scored versus the non-scored portfolios. And in all cases, I think you highlighted here, in all cases, the non-scored outperforms the scored. get a higher Sharp, a better return, lower vol, lower drawdown. And this is kind of telling you, well, saying very clearly, again, the scoring does not help your overall portfolio performance. Taking into account the score when building your portfolio is not going to give you a better result. The best result is coming from taking into account the asset selection, so the true work of choosing the however many assets there are out of the universe and building a portfolio from those. It is not, there is no extra information in the score. In fact, there is negative information. You can see the extent of that negative information. However, however you want to look at it on the table, but a reduction in Sharp, a reduction in return, an increase in volatility. So no score approach, we agree, is better. Should we use the longer returns, the longer holding periods, the shorter holding periods, or the raw holding periods? Well, it would seem from this that the longer holding periods are better, primarily because you get advantage of more stocks at any point in time, which gives you more stability and more time for the alpha in your selections to come through without the idiosyncratic single stock risk of having a portfolio that has less stocks in it. And I think at the end we'll discuss why in this particular portfolio that's very, very relevant. Shorter period clearly has the highest return, but has the most instability or the least stability. Higher vol, higher drawdown, and really you can kind of trust the data a little bit less because you have these periods where you have much fewer assets in your portfolio. The longer period, more assets, lower vol, lower drawdown, and a higher kind of average Sharp. But if you take into account the short periods final spike up in these last 5 or 6 weeks of this graph, the short period does outperform. You have to ask yourself, is that something you want to stake your future on or not? Typically, we probably wouldn't. So what we're sort of saying here is like from a set of asset selections and scores that start at the very beginning of this process, we can look at what's the better ways of using that information in the portfolio construction process. So it's not saying there's a direct formula for taking the work of the analyst and the PM and saying this drives this in this portfolio, but it is saying if you can understand what are the inherent characteristics of your asset selection and scoring process, then you can get a much better result at the end. It's not that you have to do fully non-score or fully scored, or you have to take persistence level 1 or 2 or the raw. You have to have a look at which one suits what you're doing, and you have to think about what is the driver of why this is a better version, why one version is a better version than the other. The data itself isn't generally enough to give you those answers. You do need to think in a sort of expert system manner, have your own domain expertise about how you go about making your asset selections and what that translates into what is useful in an asset, in a portfolio situation. Because again, remember, when you are making your asset selections and you're scoring, you tend to be thinking about single assets. But the lived experience of your LP is the experience of the portfolio, not of those single selections. And it's the transformation of
this is what we talked about last time.
Yeah, which is our kind of course, our main topic of conversation is providing a lived experience for the LP that is as favorable as possible. So in this particular case, we come out with this is a long hedged portfolio. We come out with the idea that having a longer holding period works better, but we shouldn't differentiate from the scores. We shouldn't differentiate based on the PM scores our desire or basically the amount of risk we want to take on any particular asset. Now, that's all about stage one, and we've kind of gone through it a bit fast, and I appreciate that lots of subtleties and differences in different organizations' methods of doing this. But fundamentally, at the end, we have got to a point where we say, for this particular PM, this is the way we would want to take inputs. We want to take the inputs with no accounting for their score, but we like the asset selection. We want holding periods of the longer period in this. And then we'd pass it into, together with all the objectives and constraints of the business. What are you trying to produce? In this case, a long hedged, low vol portfolio. Pass it through our calculations and see what sort of portfolio we would produce. Our Sherpa, this is our core business. And this brings up in the last few minutes here, this brings up a very interesting extra point. And it's something we talked about in the last webinar, but let's revisit it here. You can see here the four lines. Well, the purple line is the benchmark S&P, just so you know that it's what's going on in the world around this time. The black line is, as always, the P&L of the score-weighted assets. The green line is the P&L of the non-score weighted assets. So it's better than the black, and we've explained why that is many times. And the blue line is what comes out when you pass those same inputs through the Sherpa maths process, taking into account all the same objectives and constraints as the other lines. And you can see the blue line, the Sherpa line, extensively outperforms. And actually, these are real data. So we've taken real data, and this one actually is beyond expectation outperforming. I had a Sharp of 3.4 for Sherpa. It's amazing. Don't expect that every time, but it's an indication of what can happen. The really interesting question is, what's going on here? In this period where Sherpa massively outperforms your standard, but the simple question of taking the scores, even in a non-weighted, with all the best things we've decided upon, why does the Sherpa portfolio outperform so strongly? Well, when we built this Sherpa portfolio, one of the things we did was in answer to the request of the PM said, well, listen, our LPs for this portfolio are they're consultant-led, and they're specifically looking for factor neutralized portfolios. So the Sherpa portfolio, I'll just go back up a page, it's factor neutralized, not just market neutralized. The black and green lines are market neutral. They've been hedged to the market, but they're not factor neutral. Any factor biases inherent in the selections are also inherent in the portfolio. When we look at what the factors did, and these are the pure factor returns for the US mid-cap market thing over this same period, we can see particularly that during that period, the value factor decline, or if you owned a market neutral book of purely value stocks relative to anything else, you would have lost significantly. So, and this is the same period in which Sherpa portfolio significantly outperforms. So if we take, again, this line is the pure signal, and we hedge out the value factor, we get a line that's much closer to the Sherpa line. So the orange line, which is the signal with the value factor hedged out, is much closer to the Sherpa line, which is telling us that the real reason why Sherpa is doing so much better than the pure signal is that signal contains a long value factor. And actually, of course, we can run an attribution. We did. And when you do an attribution on that portfolio, the portfolio of raw signal, you get quite a lot of risk to the value factor. So the Sherpa process in this case was set up specifically to neutralize these factors, and it has done, and you can see you get a much better result. I think you can see here, even when you neutralize the value factor in the raw signal, you still get a much better result in Sherpa, because actually not only have we neutralized the value factor, we've also neutralized growth, momentum, so else, and basically neutralized all the things which introduce volatility or risk that isn't part of your alpha. Your alpha here was specific stock selection. Your specific stock selection contained factor tilts, it so happened, and that was never, it wasn't intended. It was like, we like these stocks, but the factor tilt was inherent in that selection. If you can remove that factor tilt, you'll do better. If you can remove all the factor tilts, and maximize the exposure to your risk and minimize your drawdown, which is what Sherpa process does, you do even better. And again, Sharp of 3.4, fantastic. Let's not, hang our hat on that.
This is more in line with what most of our clients see. This is just shy of 3% per annum improvements in returns, and a better control on the downside risk. I mean, is that the fact that this set of ideas has potentially very good risk stability, maybe overstates this from a Sharp perspective, but 280 bips of improved returns and better control on vol and drawdown. This is why we say the previous example, going from the naive one to the Sherpa one, maybe was way above expectations, but this, is in line with what we might expect.
Yes, exactly. This is a typical experience of our clients, is getting this 200 plus basis point better return, lower vol, lower drawdown. So, Stephen, what have we think we've learned from this?
Well, I think the summary right there, right? And this, what I think Richard talked about earlier, it's important to view this whole process as a question of understanding your inputs so you can make better decisions to drive better results. If you took this whole set of decisions and you said, look, I want to go for that shorter holding period because I want to chase after more returns and I'm willing to accept maybe more idiosyncratic risk, that's fine. But that's an informed decision. And if we looked at the shorter holding period versus the longer holding period versus the original raw data, all three of those were passable results, but both of the sort of sensitivity tests gave us better results. And so if we think about this, there's a lot that just, not sort of digging deep into your process of scoring, not digging more deeply into the process of thinking about how your ideas have persistence. There's a lot of ways you can take that, but there's a lot that you can leave on the table if you don't understand really the characteristics of your ideas, the characteristics of your input, or as we said at the front, what you're good at.
Exactly. Potential alpha left on the table is the issue which we are here to solve. Oh, sorry. Exactly. Next page.
Well, and so again, this is like we talked about at the top. If we think about this as a process, sort of a loop, an element of trying to have a very objective, systematic process to go from alpha construction to delivering the portfolio that your LPs want. Understanding your alpha is critical to how the whole process starts. And so in probably one of our near future sessions, we'll be talking about, understanding the objectives and constraints a little bit more as well, understanding kind of the problem setup that we come to bear on calculation. But it's critical that you think about really at what detail you understand and how much you understand kind of the variability of what you can do with your alpha. And so if we, this one speaks for speaks loudly, I think.
Yeah, on the left you have the raw signal, and on the right you have in the blue line what that raw signal can produce when properly understood and properly managed through the process of capturing alpha. But there is nothing in the process that we have done to create the blue line on the right that involves external information that isn't existing in the signal on the left. But it's the way that we've gone, the way we've taken that signal, all the information in that signal, and built the portfolio that creates the blue line that is the interesting part. And that's where, I mean, this whole series of webinars is called Process Alpha. There is asset selection alpha, which you can see on the left. The gap between the asset selection alpha and the graph on the right, we will call that process alpha.
Couldn't have said it better myself. So the surprise final note here. So this is a systematically generated alpha signal by a partner that we work with here at Sherpa Funds Tech. One of the new initiatives we've been working on that sort of isn't out there in the public domain too much yet is a program we call the Sherpa External Alpha Portfolios, where we work with leading systematic alpha sources, AI, statistical alpha, factor-driven alpha, but people who produce alpha in a systematic process, thereby, really putting in the PM's hands, understanding that alpha and understanding the portfolio they want to create from it. And so this is really an example of how we went about thinking about this particular source, about this particular set of ideas, equally applicable to a traditional discretionary PM. And so in future sessions, we're going to talk a little bit more, really start to unveil and introduce this external alpha portfolios concept. But if you are interested in learning how some of our partners are deploying these strategies, feel free, reach out, let us know. We're happy to talk about this particular data feed or some of the other feeds with maybe a little bit different set of characteristics or different sets of markets you can capture. So with that said, contact information is here. We appreciate everybody taking the time today. We went a little bit over time, but we had a fairly dense topic. If anyone has questions, by all means, put them in the chat now. We would be happy to spend a few minutes going through questions. But if everybody's sort of already used the time they blocked out for this today, we entirely understand. Richard, any last words while we wait to see if we get some clarifications in the chat?
No, I think, I mean, there was a lot of graphs and numbers in there. I would just, at the risk of losing our contact detail, I would just go in your minds, think about this picture. You are running money, you have a great process for selecting risk positions that you want to be in. Those risk positions you want to be in, those selections generate pictures like the left, typically. The experience of your LP, the experience your LP wants is the picture on the right. And think about the ways you go from one to the other. And there are the 5 steps in the Sherpa approach. You have your own steps, but thinking about those can really help transform what intellectual property that you have, that you've generated by this asset selection process, transform that into a really investable, sellable portfolio that the LPs like.
Absolutely. No, and so we don't have a lot of questions, which I guess means that we've once again overwhelmed people with charts and data. So Richard, thanks so much for taking the time to walk us through all this. Everyone, thank you for taking the time to join us today. If you came in midway through, if you are joining us at the jump, this will be online on our Sherpa Funds Tech Process Alpha YouTube page. We'll also have a bit of a summary on the Sherpa Funds Process Alpha blog. So please, by all means, catch up if you missed part of it. We'll be talking in the future. Should have a new webinar announcement coming out in the near term, talking about some of these same concepts we talked and sort of taking it to that next level again. But if you want to learn how you can refine your process to get the most value, to extract the most value from your hard-earned, hard-generated alpha, please get in touch, Sherpa Funds Tech. So thanks everybody for taking the time today, and we will look forward to seeing you next time.
Thanks very much. Thanks very much, Stephen. And thanks for everybody.